All right, so today we're going to talk a little bit more about strategic play across the global economic front and how all this might play into Bitcoin, crypto markets, but more importantly, maybe even your own personal bank account. We'll get into all that good stuff today. My name is Paul Barron. Welcome back into Tech Path. Let's roll it into our sponsor today, and that is Ledger. I think this is another company. Every time things hit the fan, it feels like Ledger benefits from this, and that is doing self-custody and getting into holding and becoming your own bank. This is one of the ways to do it. You can do it a couple of ways. They've got a couple of new projects out there, products, I should say. They've got the new stacks coming out, I think, as early as this month, though I have not seen this quite yet. You can get into the Nano X. You can also go into the Nano S Plus. So lots of cool options here. If you compare their devices, it kind of shows you here some options. So depending on your budget, you guys flex it and figure out which way works for you. But self-custody is the one thing that I do coach a lot on getting into crypto, learning how to do self-custody. Number one way to do it, use the link down below. It's going to help the channel out. We appreciate it. All right, again, a lot happening in the global markets. Credit Suisse, we'll talk a little bit about that today. I want to jump over to the whole scenario of where the market might be going from an inflationary standpoint, because this FOMC meeting coming up is an important one. In fact, it's got a new set of data points that really have not been talked about by Chair Powell before. This will be the first time he addresses that, and that is the financial stability of the very reserve asset we have here in the United States, the US dollar. All of this could play into it. So I want to jump over to a clip from Real Vision. This is Raoul Pal, and if you guys don't follow Raoul Pal, you should. And he's got Jeff Moore, who's one of the heads over at Fidelity, talking about this very issue. I want to play this clip.
And I started Fidelity in 1995 as a credit analyst.
Okay, so let's dig into it. When we spoke last year, I was getting more bullish on bonds, and you're like, no, I think we need to wait. And you were clearly right. So I'll give you that. So let's go with first your big picture framework, and then we'll kind of narrow in on some time zones and talk, various parts of the market, because I know you focus on all sorts of parts.
Okay, so thank you for thinking I was right, but what I've learned as a PM is the game that never ends. So the game's never over. So the key for all of us is to realize that and just to keep soldiering on some days. So interest rates now are actually pretty attractive. The 10-year yield touching 4% plus minus. That's a pretty good entry point in my opinion. In fact, I'm going to say this: if you don't like bonds now, you just don't like bonds. Right? Keep that in the back of your mind, that this is a pretty good entry point, regardless of your sort of view on the Fed, whether they do 25 at the end of the month of March or 50, a surprise 50. The bond market's in great shape that way. And the key question mark for all of us, the only question, is what's inflation doing? And the way that I look at inflation, I'll give you a quick hitter on this, is I think we hit peak inflation late last year, okay? And now the question you have, if you want to use a ski analogy for all of us in the North, are we in a green run, a blue run, or a black run, right?
Love it.
And I would argue right now we're in a green run. We're still trending down, we're at the Fed's core CPI expectation of 3.5% by Christmas or next year or this Christmas looks possible, maybe probable, maybe they're a little off. So that puts us on the green run, which is to say the bond yield curve is going to start getting steadier and steadier.
All right, so what he's getting at here is how sticky is inflation and going forward. Because remember, Powell is going to make his assessment based on what the data that's coming in on these kind of scenarios, which is exactly what Fidelity is doing around how to deal with bonds and also some of these instruments that are drawing in around 4%. Again, this gets back into banks and why the banks are in the kind of position they're in, what we're seeing in terms of liquidity moving into some of these alternative assets. So all of this starts to play into a bigger picture of all this going forward. I wanted to play a little bit from this clip right here. This showed something we were showing from CTO Larson, but let me play this. But Credit Suisse, actually, this right now, potentially really starting to maybe be on the ropes. And I just heard this weekend from some very influential people that Credit Suisse is offering upwards of almost 7% returns. That always worries me when we see those kinds of offers to major major liquidity operators out
Oh, yeah.
there. What do you make of Credit Suisse and their current situation?
It's over. Okay. They will fail. They will need to be bailed out. They are a systemically important financial institution with about $13 billion of market capital when they actually need at least 10 times that amount to properly capitalize their balance sheet. Okay. So this is the last, you're seeing a bank run occur in real time in the wealth management division of CS. Okay.
Yep.
It used to be CS First Boston when I traded with Wall Street, but now they've taken the First Boston out of their name. They might have 196 years of track record or whatever it was. That's commendable, but they're horrible risk managers. I mean, you saw the disaster that happened in their prime brokerage group.
Prime brokerage.
You've seen crisis after crisis. They are horrible risk managers. They will be bailed out or bailed in. You know what a bail-in is? When the depositors lose their money, and all of a sudden, like in Cyprus, that's what happens with the banking system. Now, look.
All right, so this was a piece that we did. I would recommend that you take a look at that Greg Foss video last week, because we were actually talking ahead of all of this turmoil that was happening within the banking industry. Obviously, Greg's insights on Credit Suisse, dead on. And when you look at what the scenario that's playing out right now, Credit Suisse, what's happening right here, should we be worried? Yes, his statement is right. And when you think about Credit Suisse, their biggest investor, which is one of the Saudis' largest banks, who are locked in at around 10% of equity in Credit Suisse, they are not interested in injecting more capital. That always worries me when one of your best investors, typically it's done like in the VC world, you go to your VC investors and say, hey, listen, I'm a startup, I need a little extra funds. And your VCs are the first to offer instruments of capital to get you back on your feet for whatever reason. This was not the case for Credit Suisse. So what does that tell you? It tells you that this particular bank may be on its deathbed. Now, I want to get into some detail here with Lynn Alden and what she is looking at around bank insolvency. Let's go to the full screen on this because there's some detail here. So this was her newsletter, a look at bank insolvency. She's looking at the market overviews, but there's some charts here that I want you to pay attention to. This first one right here is total assets of all commercial banks against total liabilities, typical P&L of any other business. You would look at this and say, what the F is going on? Total liabilities, of course, intersect, and we start to see this separation right here around 2020. Liabilities and assets were kind of okay, but then we start to see that separation, big spike right there, and then this full separation right there, again, of all the total assets on commercial banks versus liabilities, continuing to get closer and closer. Further into what she was talking about is deposits on commercial banks. Last time we saw a major exodus, guess what? It was right there in the 2008 zone. This is 2008, guys. This is the last major banking crisis that occurred. And look at this exodus right there. This is before social media. 2008, we barely had Twitter and Facebook at that time. When we were starting to see this, and definitely not to the ramifications of how it affects global movement and sentiment in the markets now, because everything moves like a wildfire. Now we're out here in 2023, and we've had one of our first scenarios play out with SVB, which of course could play out now with Credit Suisse. Further into her research, she's talking about this was the bank cash and treasuries as a percentage of total assets. Again, look at this. This is the 2008 zone. And of course, our dipping. Could we see this kind of move downward right there, all the way from, if you think about right there, around mid-2000s to 2010, which is when we started to see the restructuring of the markets. And this is essentially what we've seen over time as we started to move forward. And this is another problem. Treasuries versus total bank assets, another big one. I don't want to look at that one. Oh, here, federal funds rate, percentage change from a year ago. Look at this. Massive moves. All of these are not good signals. Banks have also, they have a lot of unrealized losses. Banks buy a lot of securities. So they basically bought in all these bad spots, and now they're, like, Greg was referencing, terrible risk managers. In many of these cases, SVB is a perfect example of this. Credit Suisse is the next example of this, along with many others. First Republic, many of the other smaller banks that are most likely going to be dealing with this. The concern I have, again, goes back into the issue of what if this happens with more banks? How do we backstop them? The problem is that there's only so much of that backstop fund available. It cannot handle another major event. If it does, then we will fall back to the standard FDIC insurance. You won't be getting 100% of your deposits back like what SVB did. And then I wonder, why was that bank selected to get 100% of their deposit back, those depositors? Interesting. If you look at the connections to Silicon Valley, look at the connections to Gavin Newsom, look at the connections to the Biden administration, and now you start to put the pieces of the puzzle together. You've got Larry Fink coming in and saying, listen, I'm raising the specter of a slow-rolling crisis in the U.S. financial system in following the failure of the Silicon Valley, with more seizures and shutdowns coming. This is Larry Fink. These guys control almost $9 trillion in assets, global money manager at BlackRock. These guys, if they're looking at this, they know what's up. This is not, and the reason is very simple. Multiple years of pretty much free money. Remember when we had zero interest rate? Those are the kind of leverage positions that really put us into play. And remember, a lot of these guys, money managers today, never saw 2000, never saw it. Never saw the dot bomb and what kind of devastation that did to the market, with almost $8 trillion just in the tech sector taken out in about 3 to 4 months. So big factors here playing into the market. Wells Fargo is another big factor, going for a $9.5 billion mixed shelf offering. Now, what this simply means is it's debt securities, warrants, units, and purchase contracts. That's what it's going to be in the offering. It doesn't indicate a sale that's begun or will occur in the future. The company intends to use the net proceeds, interesting statement here, for general corporate purposes, $9.5 billion. This also concerns me of where all this plays out in the U.S. banking market. This concerns me because when you look at the U.S. markets and you consider the global reserve, then you look at the banking infrastructure that lies underneath it and how, in essence, how weak it is right now. And the thing about this, if this was in 2008, you would not be hearing this anywhere. You wouldn't be hearing this on YouTube because it wouldn't be pushed out, because social media has essentially repositioned the way news and information is procured and distributed. The mainstream media would have continued to control that narrative, and you would have never heard it or known it had it not affected so many. We showed a chart the other day of the trickle-down effect of what happened with Washington Mutual and the impact that 2008 had on so many other banks, and eventually one of the biggest economic downturns we've experienced here in the United States. Here's First Republic, which is the other bank that we think is right on its deathbed. Listen to what Yahoo had to say about this one.
Bank now has been cut to junk by Standard & Poor's and is on negative watch. The shares are plunging once again here this morning. This is its long-term issuer credit rating going to BB plus from A-. What does that mean? It basically means people who hold this debt, they're now going to be seeing quite a different risk profile on that debt as it is now being deemed junk. We're going to talk more about.
All right, so if you were a investor in First Republic, your investment pretty much just went to zero. It was an NFT. Might as well have been. If you were an investor in SIVB, Silicon Valley Bank, another one, because gone to zero. They're not bailing out the investors, which is an interesting scenario when they say bailout. It's not a bailout. Well, if it was a bailout, then the investors would not have been harmed, and they were harmed. So this is, in essence, a bad scenario that plays out in a various number of banks. Do not think that we are not going to see the end of this. The other thing that's so has so much hypocrisy is this right here. Binance's U.S. acquisition of Voyager, the assets now challenged by the government. Now, remember, there's a lot of U.S. investors in Voyager right now that would benefit from this. So you're immediately attacking the pocketbooks of your voters, and you're doing it in a way in which, well, wait a minute, we're okay with let's bail out this mismanaged bank over here because it affects Silicon Valley and a lot of the funds that are going to go into our campaign strategies for the next run. Let's not forget about that, okay? The amount of companies that are being basically restored to 100%. Imagine what they're going to do with those funds when it comes to campaign finance. But right here, when it comes to just bailing out a bankrupt company, Voyager, and being able to set this record state for a lot of those investors and people holding those bags, this gets held up again by it's hypocrisy, double-edged sword, standards that it just shows the greatness that we have here around interest around other things. I just don't like it. China is another one. This one gets a little bit scary because they're adding liquidity again. The reverse repo injections ticking higher after 2 weeks of nothing. Now we're starting to see this moving. And again, this gets back into my whole theory is that China is on an economic warpath right now with the United States in a period of time in which we are at our weakest. What is that? Well, financially, highest inflation, situation on issues with jobs, real estate, and so on. Now we have banking unrest and the financial system. Why wouldn't they be adding liquidity into their markets at a 1% inflation rate? Why wouldn't they be doing these kind of positions and possibly queuing up for the next potential global reserve, which may play into some very interesting aspects on this? Here was Christopher Baroud. He talks a little bit more about this. China steps up cash support as growth recovery mops up liquidity. China injected the biggest amount of cash to its financial system in more than 2 years via a medium-term loan. This, again, only shores up the position of where China is going on this. This could start to shift a lot of the cycles, and this gets back into the thing I look at. And if we have enough turmoil here in the United States in the financial system, if there is any hint of faith in the system that starts to fall, then we as a country are at super risk. It only means one thing, that the government is going to flip the switch. We are going to see another unbelievable taxpayer-funded bailout of these industries and to save the American economy, which will do what? Devalue the dollar and continue to put more inflation pressure, which is that double dip that everybody has been concerned about. Could we get it corrected before all of this happens, before 2024 is the real question. A lot of things in moving parts in the industry, but China is one that I'm watching very closely. I'm going to play a clip here from a guy by the name of Kyle Bass. Now, Kyle Bass is an analyst and has been, I will say, he says a lot of things that are a little bit out there, but sometimes he does get it right. And his position is that we are on an economic war right now with China. Listen to what he had to say on this clip.
Pleasure to be here. I think that you just announced that you're going to see further and further restrictions on investment in new technologies, investment restrictions, investing in technologies over in China with American money. And, I constantly point out the rift, or let's say the chasm between the Director of National Intelligence's report to Congress each year and Wall Street. When you go read the DNI report for the last 5 or 6 years, you see that in unambiguous terms, the Director of National Intelligence for the United States lists China as the #1 threat to U.S. national security. And then you go to Wall Street and 11 or 12% of their revenues continue to be derived by China. And we keep funneling capital into Chinese SOEs, Chinese banks, and Chinese technology companies. It actually makes no sense whatsoever.
So his point there is pretty simple. If we have a national security threat, if this is occurring, why are we still seeing these kinds of support mechanisms in the economic front into China? And again, if you're only fueling the fire over there, where China is re-injecting capital into the system, looking at opening up potential crypto-savvy banks within Hong Kong, playing and laying down the potential framework of what might become a new frontier when it comes to digital assets, all of this could be a very strategic and interesting play coming out of China. Again, not necessarily China FUD, but the point is when you look at the global economic scenario, when do you attack your competitors? When they're weakest. A defense, if the defense is weakened by their best player, the banking system is weakened, when do you go after that potential? That's where I see some of these play situations. And again, guys, if you're not already pushing into a scenario of reassessing how you're doing your financial stack, you should be. And what I mean by that is the diversification of how your money and how your assets are spread up across the least amount of risk as possible. And if some of that is Bitcoin, maybe some of that is gold, maybe some of that is real estate or tech investing. small business investing, your own business, cash, understanding how to manage all of that is really critical right now. And a lot of what we're going to see within the next few runs is going to be pretty significant. I want to get into another thing with Bitcoin. We'll take a look at some charts here real quick. Let me open up because I didn't bring up the charts real quick, and I do want to get into a poll. We've got some questions coming in today. While I'm doing this, let's take a look at the poll because this will be an interesting one. All right, if your business bank went under, would you use Bitcoin for business transactions? 74% of you says yes. So what that simply means is, hey, I'm going to keep doing business, my bank for whatever reason, but I'm going to take Bitcoin in. The likelihood, and this is a poll that I've ran in front of a lot of business leaders that attend our weekend private, wealth seminars here in Florida. And most of these guys and women are business owners. And I ask this question a lot is, would you guys pay your employees in Bitcoin? If they said yes, many of them, not quite 100%, but very close. Yes, I would do that. Would you be able to take Bitcoin in lieu of cash? Would you do that? Most of which are just like you guys, playing in on that position. So I think it's a big deal when we see this because it does start to put the framework in place of, is there an alternative out there? Is there something out there that we could use? And of course, we all know that, and that is Bitcoin. I want to jump over to the charts real quick. Bitcoin, of course, adjusting now to 24.4. We did a show earlier today, our altcoin show with Evan, and a couple of things there is, again, back sentiment numbers that we pulled in here. This was back on Wednesday last week, or on the 1st. We saw a liquidity opportunity. That, of course, did fall in line with the CPI is showing. Same thing scenario here with on Saturday. If you're in our mastermind group, you guys already know a lot of the kind of trade alerts we put out. I will give you guys a free one here today, and that is right now, Bitcoin is dropping in sentiment. We're seeing this. If you're in our CPI, you're probably already seeing this on the dashboard today. We'll open up. And I just want to pull up data, starting to see. Okay, so there's the Bitcoin overall chart right there. ETH also taking a big dip, which is the gray one right there. A little bit harder. This is the top line sentiment. If you get into the CPI, you can pull and understand a lot of all the crypto that we do track, which we track a ton of coins. Over there, this, of course, is our top crypto group, and this is our metaverse group right here. So all that's available over on the CPI. Let's get into some questions. Gold and silver, interesting. Well, not bad for diversity. I'm just not, one of those. However, that's not a bad issue. I mean, we've started to see some movements there. I can't believe I would even align with Peter Schiff on that. Jimmy says, Bitcoin is not a bank killer. No, I don't think so at all. I don't think Bitcoin is a bank killer at all. I think it's a supporter of the mechanism so that we don't lose track of our overall financial system. That's a concern. Web3Me says Bitcoin can't handle mass adoption for transactions. ETH is definitely scaled to. I would agree with that 100%. But let's think about this for a second. Could Lightning play into that? When you think mass adoption, don't think in the terms of as much of the market that uses credit card, debit card kind of transactions. First of all, that would never happen. But if you had 5% of the market, 8% of the market versus less than 1% of the market moving in, I don't think that's mass adoption, but that is massive moves in terms of liquidity into Bitcoin. That I think is manageable. However, ETH, different story. It definitely has that capability of moving. ETH is another one that I think also falls into this. If it wins the commodity war, yes. Jen Smith that comes in, I would like it if he offered a bailout, then changed his. Yeah, that would be a good one. That would not be a good one. That would not be a good one, Jen, for sure. CZ is not liked by the system. I would agree with that. I think CZ is a marked man. Soto comes in, says the issue with using Bitcoin for business transactions today is that it's too volatile. I would agree with that, but is it more volatile than you losing everything over 250K? I don't know. If you're a business and you have $1 million in the bank, and your $1 million in the bank, if you had a failure, went down to 250, you just had a 75% drawdown. Is Bitcoin more volatile than that? That's the kind of scenario that you might want to play into. This is if doomsday hits you. If doomsday hits you. So for sure. Money printer is about to go burr. I think you're right. ETH fees are too high. But they're always going to be. We got to get under that. I think that's a scenario that will continue to play out. But it is one that I like. There is going to be some fixes on that, but at the same time, it is one of those things. If you can't withstand a bank run, you should not be in the banking business. That's for sure. But you got to remember, guys, this is a fractional reserve system that's been around for 45 years. This is not going anywhere. Yes, these guys. You go to your bank right now today. Go to your bank right now. If you have, let's say you got a decent amount in there, go try to withdraw $25,000 in cash. Tell me what happens. Most likely, you'll be turned away, and you'll have to set an appointment to be able to get to that kind of cash. There will be all sorts of things going on to get to that cash. Right now, if you're doing wire transfers, we just tried to execute one yesterday, and we're grilled through the fact of moving those kinds of numbers out of that bank. They were literally, I got a phone call from one of the bank managers. What's going on? What are you doing? That worries me when those kind of things happen. Fiat is the best transaction, like shopping. Bitcoin more sense for saving. Yes, I agree. I expect most people said yes, do not own a business. I don't know, Michael. I own a business. I'll take Bitcoin right here today. If we could integrate any kind, this is another thing. We have a lot of membership programs. We have yet to find a merchant program where we can offer those recurring fees for membership programs. If we could find that, a good one, because there's some out there that just don't integrate well. If we found a good one like a Stripe or something like that that could do that, I would turn Bitcoin and ETH on in a minute for that. Because of the volatility, I'm not even worried about. This is long-term play when you think of reserves for a business, because really all you need is certain liquid reserves. The other thing that would make this a perfect run is the ability to have loan instruments come back into the play around this, which I think eventually will come back into major banking of using digital assets like this for loan reserves. So all that. We probably should do a video on that. We got a bunch of guests coming on later in the week. I think we got Rand coming on from Crypto Banter. We're hoping to have James from Invest Answers come on. So we've got some guys coming up that I think you guys are going to listen to around strategies, but also around how this economic pressure plays out. Because right now we're in a very key and critical moment. The next FOMC meeting, get some popcorn. It's going to be an interesting one to watch. Of course, if you're not part of our Diamond Circle, get in there. It's free, part of our Substack. It's really where we deliver a lot of our content, emails, additional podcasts, additional stuff. We just dropped another alpha piece in there today for our paid members. So kudos to you guys. Make sure and do it. The link is down below. And lastly, I just ask for you guys to do one last thing before you leave. Hit the like button right now. Just smash it in there. It does help this video get discovered, and that helps many others that are trying to figure out a way out of this mess. So all that's good. Catch me out there on Twitter. It's @Paul Barron. We'll catch you next time right here on TechPath.